Howdy, Jacob here. Today we're looking at Lamb Weston Holdings in the food products industry. Just under 15 billion market cap on 18 billion enterprise value. Founded in 1950. Been around a little bit. Growth appears, it's almost doubled in the last 10 years, but we're looking kind of all over the place. Last 2 years, very heavy increase, but other than you take out this year, you're looking pretty consistent on your earnings, pretty consistent on your revenue growth. Let's look at that balance sheet. We did see quite a bit of net debt here. So 305 million cash on hand, 3.5 billion in short-term and long-term debt. So we do see that there's a good amount of net debt here, 3 billion roughly. And that's pretty substantial in relation to their 5-year average free cash flow. That is probably looking at about 400, 300 million. Let's say 300 million. That's 10 times their 5-year average free cash flow. So fairly concerning just looking on that. Obviously, you're going to have to do more research to see when that debt is due. But from a quick glance, that's a good amount of debt and fairly concerning based on the fact that their free cash flow is their average yearly free cash flow is um, it's going to take 10 years just to pay off that debt if 100% of it went towards it, which we can see it absolutely does not. Their use of cash flow is pretty heavy on the acquisition side, a good amount of share repurchases, and then that dividend takes up probably 50% or so of that free cash flow. I think I'm ready to start making some assumptions here. Not nearly as sexy as some of those other companies we've seen. Let me look first if there's an acquisition here. Okay, yeah, so 610 million acquisition makes sense for that hefty increase in revenue. Um, so let's say that the company increases slightly higher than inflation due to making some solid acquisitions, maybe 4%, and then um, I don't know if they've consistently had a great return on the money reinvested back in the business. And it looks like they are paying a dividend and buying back a lot of shares with their money, so not quite reinvesting necessarily. So maybe let's give them a market average 15p in price to free cash flow. And then I'll probably do relatively in line with the average earnings and free cash flow. The only thing I don't like, or another thing I don't like, is free cash flow is consistently below um, their earnings, which is not as sexy as I would prefer. Maybe let's do 9, 7 share change, buy back 0.5%. Dividend, it's already paying out 50%. I want this company to focus on um, paying down that debt. I'm even questioning whether I do this. So I'll say just because for right now, I think I'm comfortable with these assumptions. But in reality, I do want this company to really start focusing on that debt because 10 times 5-year average is a bit concerning for me. And I don't base it off earnings. I base it off free cash flow, lifeblood of the business, and that's just not at a price point that's making me, really go anxious to get in on it. But hopefully you enjoy the video and have a great rest of your day. Thank you.